podcast. I'm here with David Brickell. He is the Director of Institutional Sales over at Paradigm. David, how are you?
I'm good, thanks, Greg. Yeah, thanks for having me on. Good to be here.
Yeah, absolutely. I'm really happy that you came on. I thought, maybe we could start with a little bit of your background, how you got to Paradigm and CryptoVol, and kind of take it from there, and then we can explore further what's going on in the macro world.
Yeah, so I guess career-wise, spent about 18 years sort of macro trading and sales across several top-tier investment banks in a mix of sort of rates and FX. So very much the sort of macro kind of lean to everything I've done. I actually started life as an economist before moving into trading roles. So that was my career. I was at Lehman's in '08, so I had a front row seat to things that were going on there. And post Lehman, a big part of my kind of macro thesis was this Japanification of the Western world. The idea that we'll need ever larger central bank balance sheets that will necessitate ever lower real rates and all the issues that causes with currency debasement. I still kind of think we're in that world despite this tightening cycle that we've seen. And ultimately, what that meant was, the response of the Fed and other central banks in '08 was to artificially inflate the assets in the system because that was the collateral that was underpinning the financial system. And once you kind of walk through that door, it was like you can never really step back and step away from it. So therefore, you're constantly going to be artificially inflating assets and essentially debasing fiat currency. So the question became, what's the end game? And for me, the end game was '08. That's where we should have had the reset. But I understand that that's less difficult decisions for any policymaker to sit back and let happen. So for a long time, I was sort of long gold and just sort of long assets, property, NASDAQ. You can kind of pick what you want and be long. And then I got introduced to Bitcoin. And then it started to put the idea in my head that maybe the existing system doesn't collapse or disappear, but we kind of slowly migrate to a new system. So that started my kind of interest in Bitcoin, which kind of grew as more like just buy and hold investor. Still am. Badly ran some scalping bots for a little bit. Didn't make much money. That wasn't my thing at all. But meanwhile, I was sort of carrying on in bank, and my interest in crypto kind of grew. And then I think like in the post-MiFID world in banking, I think world of FX got quite dull. Vols collapsed to, I think at one point Eurodollar vols on a 4 handle. And I think more and more my mind was turned towards crypto and looking to move my career. I was looking to do it in like 2019 career-wise, and then COVID happened in 2020, and then sort of stayed put for a bit. And then in 2021, sort of made the jump. And long story short, ended up at Paradigm, where I'm now as Director of Sales and sort of heading up things in London.
That's fantastic. Well, there's a lot that I want to dig in there. So I definitely want to dig into being at Lehman during the financial crisis. That's super fascinating. I want to just touch on real quick. So for those who don't know, or maybe for my own interpretation, so you say the Japanification of sort of the Western world. So that's the idea that Japan had this big property bubble and market crash, and essentially all these corporations were under. The Central Bank of Japan was sort of the first one to have zero interest rate policy, zero bounds, quantitative easing, all that stuff, and create essentially zombie corporations where their equity is negative, but they're still kind of running. And the idea that that's a trap you can't escape. Is that right?
Yeah, that's like a perfect description. And then joined to that, very similar kind of dynamics, certainly from sort of poor demographics and aging demographic. Huge debt, and debt in itself is typically sort of disinflationary over time. So there are huge similarities, but the response was pretty much exactly what Japan's done, and it created zombified economies and difficult to ever really escape from it.
Yeah, that's really interesting. And that's an interesting point about the demographics, where, for those who don't know, Japan has sort of the largest aging population. Japanese people live very long, they eat very healthy, and essentially typically you have this pyramid where retiring population is smaller than the working age population, so you can tax the working age to pay the benefits. But if it flips upside down, then from a government expense perspective, it's really unsustainable. Do you see those same sorts of demographic trends in the Western world, or is it different because of immigration policies and stuff like that?
Well, yeah, yes, I do. I think the trends are very much the same.
Mm.
I mean, interesting as well. We've even seen those trends start to play out in China as well.
Wow.
So we kind of have this global Japanification going on, and we're all at different stages in that. But yeah, absolutely, we're seeing that. And you're seeing the problems that it's causing. I mean, despite sort of high nominal growth in the US at the moment, you saw low tax receipts, and we're again talking about another debt ceiling that needs to be lifted, and we just can't escape that. So yeah, it's difficult. I mean, we've maybe immigration helped a little bit, but now we kind of, this sort of populism that exists and pushing against immigration and this sort of deglobalization movement. And then there's the technology again is another interesting kind of factor in all of this. In that technology as well is like forms part of my sort of disinflation or deflationary view of the world. How much of those offshore jobs when we go back to this onshoring world just get replaced by the robots, and more people out of work. So kind of think overall you're seeing, and you'll see this move towards there being less people in work, which becomes an issue when you've got a retired population that all need looking after.
Yeah, that's fascinating. The idea that technology is disinflationary is really an interesting inflection point right now with AI and ChatGPT. So, like, if we can solve complex problems very quickly, that frees up a lot of time, and essentially things become cheaper. That's a really interesting inflection point. Real quick, kind of just jumping back a little bit. So, you mentioned you're an economist. You work at FX trading desks. So, Lehman Brothers, RBC, I think I saw on LinkedIn. Is FX sort of the main bread and butter for sort of a global macro guy like yourself? Is that sort of the main place to play?
Yeah, it was funny because I started my career on the rate side. I was at RBS and then Lehman's, and after Lehman's happened, I ended up actually at HSBC before going to RBC, and HSBC was when I crossed over into FX. And it's funny that because in a bank, so there's always this snobbery between like rates and FX. Like FX was seen as, the kind of borough boys of the market, and whereas rates was a little bit more sophisticated or deemed to be so. But I actually found FX was a far more kind of macro product, in that rates and you'll often see in any of my writing and even the way I think about crypto, but like rates and FX. Rates are such a big driver of FX. So to understand FX, you need to understand rates. But then there's so many more things that impact FX from politics, from M&A and what's going on in the corporate world, and sort of flows there. It's just a far more sort of macro product. Again, like if I'm thinking, like if you're thinking about the dollar now, like and we can get into this, but whilst I think the Fed have kind of hit this pause, front end rates, if we're at a pause, aren't going to do a lot, but the dollar might do a lot as it starts to factor in other things, be it the debt ceiling, be it some of the political situations going on, and all these other things you need to take in. So I kind of feel like FX in many ways was like the ultimate macro product.
Yeah, that's really interesting. So just to summarize my understanding, so it's like typically FX is downstream of rates because rate differentials will set the trends for FX pairs, but outside of that, there's a lot of different factors that affect rates as well. I mean, FX as well. So maybe going back to Japan, like when the tsunami hit in 2011 and we had repatriation for insurance payouts, the yen went crazy, rallied super hard. So that's kind of a thing that you can't predict with rates. So FX is the playground for all these other events in the macro world that the rates guys are just not paying attention to. Is that a way to think about it?
Yeah, exactly. And it's just there's just kind of so many things that the value of a currency has to incorporate, that are out. There's so many dynamics to it. So yeah, and you see in that in terms of emerging markets are interesting in that we kind of think simplistically in the Western world, like central banks that are hiking rates means the currency goes up.
Mm-hmm.
But actually, and it's a lot easier to think about the rate path, but then you see the currency get sold off. But actually, if you're hiking rates because you've got this out of control inflation situation or have you, which you typically associate in emerging markets, then you're then just killing growth as well as and you've got this stagflationary, and then the currency goes down. So you're kind of juggling and weighing up all these different factors. And then obviously, particularly in EM, you have these like political instabilities and all those things. How does that impact things? So yeah, I think there's just a lot more that's encompassed in determining the price of a currency, and which is why I typically say I think currency and FX and the dollar, given its central role, tends to sniff out regime change quicker than any other asset class. So when I start to see the dollar change or the trends change in the dollar, it's always one that I look at to go, right, something's maybe changing here, like what's going on here. And I got obviously quite bullish crypto really sort of late November, early December, when I started to say, look, I think the lows could be in for crypto and for stocks. And a big part of that was I felt we were starting to shift into this changing macro regime, where we'd gone from that sharpest Fed tightening cycle in history, double-digit inflation, to now like the peak inflation, peak rates, peak Fed, and moving into a completely different macro regime into 2023. And it felt like the dollar was just maybe starting to pick that up early, and starting to price that. And then from that, you start looking at other things that may sort of reinforce that idea. But yeah, I kind of felt like the dollar was the first thing to just start to incorporate some of those things that you wouldn't have picked up from just looking at rates markets.
Yeah, that's really fascinating. That's great. So you mentioned that you also had followed gold. Like, can you maybe just give me just a brief outline of sort of the currencies that you follow most closely, and do you still follow gold? And then do you view crypto as an alternative currency, or how do you view crypto in this landscape?
Yeah, it's funny because I just get on my screen. I watched a list of my kind of macro like indicators, and like for the dollar, I'm always, again, I mean, broad dollar. I tend to look at like euro dollar, dollar yen, dollar CNH. So dollar CNH is really important for various reasons. I look at like some of the higher beta FX, so like dollar MEX, dollar rand. Um, so those things, and then I always look at oil. I'm always looking at gold, and then like Nasdaq, and then like treasuries, 10-year treasuries, 2-year treasuries. And and then obviously Bitcoin, Ethereum, and that's kind of the first thing I look up, when I wake up in the morning, and I can kind of get a good sense to what's going on in the world just from looking at those few assets and indicators. But it's interesting now that Bitcoin is definitely, I think, an asset class that's now having a more prominent role in the macro, and in terms of how it's impacted by the macro, and B, even the impact it has back on the macro itself and on other asset classes.
Yeah, that's fascinating. And so gold is something that interests me, especially as a U.S. investor. It's kind of the only vol market that I can really play in that has some liquidity to it. Um, what do you make of gold right now? We're sort of hanging out at the all-time highs. That this is, I think, the fourth time we've touched these levels. Feels different to me, but I'm wondering kind of what your thoughts are, if you have any on gold as a asset class.
Yeah, like I think I think similar to like saying about the dollar. I think gold's sort of picking up on this change in rates regime in the same way that crypto has, I guess, throughout the start of this year. Um, when I think about sort of Bitcoin versus gold, gold is kind of like this low beta safe haven, whereas sort of Bitcoin is this high beta. I kind of think they're both doing the same thing in many ways. It's just that you've still got this correlation with Bitcoin to broad risk. So when the world's blowing up, Bitcoin sells off with everything else, and gold often then becomes the kind of safe haven. So it always has that kind of risk premium sort of embedded into it. But then as soon as things sort of normalize and improve, then if it's a pure kind of rates play, currency debasement play, Fed, keeping rates too easy or real rates too low, then Bitcoin then starts to outperform.
Mm-hmm.
So I used to be quite invested in gold, and then I discovered Bitcoin, and I kind of think like, I mean, gold. Obviously, gold's kind of hitting all-time highs, but it kind of feels to me that it's not done a great job, to be honest, over the last sort of year or so, in terms of hedging against inflation. So you kind of like, okay, this was its moment, right? You had Russia invading Ukraine, and we felt like we were on the cusp of World War III. You've had double-digit inflation that looked to be running out of control. So a lot of the gold bugs are out there. Like, this is your moment, right? Gold should be going to the levels that you've spoken about, and it's kind of like, okay, we're touching some all-time highs, but I think overall you'd be sort of disappointed in terms of how it's traded, given all of that. And again, it depends your time frame that you're looking at, and Bitcoin still outperforms over a longer time frame. Whereas then Bitcoin, you kind of get that, okay, as we've seen sort of with the banking stress recently, it is playing a haven role, but it is playing it in the terms of, I think Bitcoin, and I think of it as a hedge against the failure of the traditional financial system. Which is why I don't think of it as an inflation hedge, although you could argue if inflation runs out of control, that's also a failure of the fiat system. But I think of it more as a currency debasement hedge and a failure of the financial system. So I think when the banking system's blowing up, you're going to want to be long Bitcoin. And then when central banks are forced into doing the crazy, QE and just cutting rates so aggressively and debasing currency again, then you want to be long Bitcoin. And you get these sort of small windows that, where they try and normalize, and we've had this sharp hiking cycle, attempts at QT, and hence Bitcoin underperforms. But again, part of my thesis is that we can't stay in those windows for too long before things start to break, because the system just can't support higher rates, and it can't support a smaller balance sheet. So as soon as you try and shrink the balance sheet, hike rates, it's not long before things start to break. And I think we're at that point again. And then the answer will be ultimately to bring rates back down, and to expand the balance sheet. And we saw that right back in March when, in the space of a week or so, the Fed balance sheet expanded by another 400 billion and wiped out pretty much all the QE they'd done since the fall of last year. And actually, if you look at this year, even though that's been coming back down as some of these things get repaid, and we've settled down a bit over the last month, the Fed balance sheet is actually, despite QT, has actually expanded so far this year. And yet we're in a QT world. So we just can't escape that liquidity, and the ultimate impact of that is to the base fiat currency, and Bitcoin, for me, is the ultimate asset to hold over gold as well, when we're in that regime which we're in now.
Yeah, that's really interesting. I like the concept of like Bitcoin trading like a risk asset and also sort of trading like an alternative currency. I kind of view gold the same way, in a sense, like it has a little bit of the FX pair reaction. So during rate hiking cycle, it kind of gets smashed because gold has no yield, but it also has all those geopolitical events that make it more valuable, kind of what you pointed out to. And then it makes me think of Ethereum as the last one, which is really interesting right now because Ethereum is still considered an altcoin, so it trades lot more like a risk asset than an alternative currency in my eyes. And we've had this year-to-date move that's really been led by Bitcoin. But typically in crypto rallies, we see outperformance from altcoins, not underperformance. And so now we're seeing underperformance from altcoins and Ethereum specifically, and we're seeing subdued implied volatility and realized volatility in Ethereum compared to Bitcoin. And it creates this kind of interesting landscape where, maybe there's an argument to be made that if this is a crypto rally, Ethereum will catch up and outperform. But if this is a banking slash financial system breaking sort of event, then Bitcoin will outperform and continue to outperform. How do you view sort of the ETH versus Bitcoin narrative, and where's your head at there?
Yeah, I mean, and I'll piss off some Bitcoin maxi on this, but I still more of a lean towards ETH generally within my own portfolio, mainly because I just think it's got a bigger network effect, and I think it does a lot of things that Bitcoin wants to do. But I think right now we're in an environment whereby the narrative for Bitcoin is so strong because we kind of back to the core narrative and rationale of why Bitcoin emerged, and largely the failure of the banking system, deposits not being safe in banks, and all these other things. So, like right now is Bitcoin's moment. I still think that carries on until we kind of. I think we're gonna still have a bit of a blow up moment in the banking system. And I think Bitcoin will continue to outperform. But then once we kind of through that again, in the same way that gold, like Bitcoin for me just feels like that extreme, end of world type hedge, and certainly end of the fiat world hedge, and you just want to be long Bitcoin and out of everything else. But then once things sort of normalize, and then maybe crypto starts trading more idiosyncratically, and then people start looking at the opportunities. Then I think ETH becomes starts to outperform again. I think as well what's going to be really interesting. Everyone gets excited in Bitcoin around the halvening event, and which is obviously typically been bullish for Bitcoin. ETH's already deflationary, so you're talking about this disinflationary event as the supply slows. Well, you've already got a deflationary asset in Ethereum. So I'm interested to see if the things going on in the macro world calm down, debt ceiling gets lifted. I think we're just going to have the moment where the Fed cave and rates start getting cut again. We're doing QE. Bitcoin will be off to the races, and then once we kind of get comfortable with that regime, and then we start to see some rotation into the alts, and then it'll come at a time when we're looking at the halvening and what does this mean, and then I think that's when maybe people look at ETH and go, actually this is already a deflationary asset. And then it's interesting whether it's gone on in the past week with the BRC20 stuff on Bitcoin and that and the congestion that's causing on the network, to go, okay, well, as kind of Bitcoin overstepped what it was meant to do. In which case, do we not just prefer ETH? So there's a few interesting dynamics at the moment. It's interesting you ask, because I keep looking at ETH Bitcoin, thinking, are we going to see ETH start to outperform from this moment? But I still kind of feel that with the banking issues in the background, and I still think we're yet to reach ahead on that. I think Bitcoin will still play a dominant role for the next few months.
Yeah, interesting. Yeah, I'm kind of having the same, just from looking at the vol space, I'm kind of having the same conclusion as well. I'm looking at sort of Bitcoin vol right now, which could arguably be pretty cheap, even though we're probably going to consolidate at 30K. But then if you looked at ETH vol being sort of equal to Bitcoin vol, that means that ETH is relatively cheap. And then you have kind of this interesting skew component in ETH. I think there's a really good argument to be made that ETH is sort of being forgot about or overlooked right now. and it's a good opportunity to sort of pick up some ETH vol and essentially some long delta while no one's looking type of deal.
Yeah, I certainly. I mean, I wrote it in the Macro Pulse this week. The newsletter, right, for Paradigm, just saying like what's really difficult at the moment is that I actually think we're stuck in this kind of rangy market, both for Ether and for Bitcoin. We had this really nice move up on this kind of peak rates, peak Fed narrative. I think what's been difficult is that there's, although Powell, set the scene for a pause last week, the data's still kind of mixed. Like the labour market still looks resilient. Signs that it could be rolling over, but for now it's still resilient. Inflation still is stubbornly high. It's coming lower and it's peaked, but it's just not coming down quick enough. So I kind of feel that we can't now fully embrace the next leg of this kind of macro regime shift to the pause and then eventually the cuts. Even though rates market is pricing in the cuts, I think that's doing that more on a kind of like probabilistic distribution type idea that, if we do go into a deep recession and things turn quickly, then you're actually looking at 200 bips of cuts quite quickly by year end. Likelihood is we maybe don't see any cuts, but net to be pricing 50, 70 bips of cuts is probably about right on balance. Without this clarity on the macros that we can kind of take the next leg higher, which I still think the next leg is higher. I think we're in this consolidation mode. We're lacking that sort of narrative of that trigger for the next leg. Now, I think that's actually going to come from the banking sector, and we keep sort of threatening it, and then obviously around the collapse of SVB, kind of government stepped in and did what it did, but we had a good move around that, and then the next moment was First Republic. But we kind of found that private sector solution with JP Morgan stepping in. I think the next shoe to drop, and I think it probably dropped. Just looking at the regional banks index is back turning lower again. That falls over the next few weeks. Then you've probably got the next kind of trigger for the next leg higher. But we're kind of in this range bound world. That it's really difficult to keep trying to buy vol and just bleed theta all day long when we're not going anywhere. Equally, given all of the risks with the banking sector, with the debt ceiling, all these other things, it's difficult to want to short vol either. So we kind of just sort of drifting in no man's land. I think we've spoken about quite a bit about Paradigm, about some of these vol overriding strategies. So I kind of think in the absence of any real conviction to do anything else, it probably just kind of weighs gradually on the volatility surface. But the point I was making in the micro pulse, if you're directional and longer term directional, then we're at really good levels to start and cheap levels to pick up some cheap optionality and leverage to play for a topside move, maybe, I don't know, in Q4.
Yeah, that's how I feel too. Like it feels like short term we got some consolidation, but also looking at where vol's priced, like it's still really interesting. Like it seems like a lot of it seems priced in. Yeah.
What's something actually to ask you, Greg? I remember when we had you on the Big Picture podcast with Paradigm, and you said something that really stuck with me about typically when vol's selling off, you want to sell it and vice versa. And play that momentum. Like, how do you feel with that now, given we keep drifting lower in vols? Do you sell it here or?
No, I'm not selling. I'm not interested in selling here. Like, typically when vols low, there's like a really steep term structure. That's really interesting. We saw that in Q4 of last year, and that makes buying a vol very expensive because you just roll down and there's a lot of theta as well. So like shadow theta from IV roll down and regular theta from just time decay. Right now, it just looks like, especially with ETH specifically, like the relative vol seems cheap. The world seems like full of unknowns. I think we're like one bad jobs report away from like things maybe moving, or we could see another bank go down, or we could see like some crazy stuff I don't want to see, like China invading Taiwan or something like that. it seems like, okay, I'm interested in nibbling at some ETH vol here. I also think if we're looking at a crypto rally, like a traditional crypto rally, typically ETH will outperform. Now, obviously, there's a good, solid narrative for this not being a traditional crypto rally, but I think like if we're playing the mean reversion game, that mean relationship should come back. And so I think there's mean reversion to be had on relative vol for ETH. I think there's mean reversion to be had on altcoin outperforming in a bull market. And I also think, long vol, a crash is good too if you're long vol. If we do have a, a recession crash, then ETH trades more like a risk asset. And so it should therefore crash more than Bitcoin as well. So I think kind of all those directions seem to make a ETH an interesting nibble here. So that's kind of where I'm
Yeah,
thinking, yeah. But typically,
yeah,
I
that
do.
makes sense.
Typically, I'd rather short ball. But right now, it's not how I'm feeling.
Yeah, no, it's interesting, and I do feel like as well we're it's just got that, my kind of spidey sense just tells me that we are on the verge of things breaking out.
Mm.
um if I look at and and talk my own book, I think for me it'd probably be to the top side in risk, and that generally I'm looking at like the dollar. It just keeps looking at this 100 level in DXY, and then backs off of it. Rates like 10-year yields like keep trying to sort of push below this kind of 340 level, and do it. They break for a little bit, and then sort of pops back up. Two-year yields had a big move lower last week, and then bang, it's popped back up. But it just feels everything's like ready to go at the same time.
Mm.
You had that flash crash in oil last week,
Mm.
and now it's kind of back up, and it's all back to levels where back within ranges that we've been for the last few weeks. I just feel the pressure's building for the dollar to break lower, for yields to break lower, for oil to break lower, which then I actually think sends gold up, which I think sends Bitcoin up, and we kind of end up having this kind of blow off top type move. So yeah, I kind of think you want to be trying to position long vol right now, and taking advantage of these moves. And it's like all things in trading, it never feels comfortable even when it's the obvious trade to do, but it feels like it's probably the time to be doing it.
Yeah, I'm right there with you. So I want to just jump back to Lehman Brothers. So just kind of going back in time here. So this is really interesting. So you were at Lehman Brothers from what year to what year?
so so and you might want to take this on board when I talk about timing of markets. I joined in 2007. So I was quite young, like just sort of junior guy on the desk. Thought I'd made it. I mean, Lehman's was a great place. Like in terms of like intensity of a trading floor and what have you. I mean, I'd probably be dead now if I'd stayed there, but it was a great experience, a great place. But yeah, joined in '07, like about mid '07. Was there about a year, and then the wheels kind of came off. I was actually out before the actual D-Day in September when it went under, but literally the whole desk were getting let go, and I got an offer to go elsewhere, and I sat down the head of trading at the time and said, look, what's happening, and he was like, look, honestly I think the writing's on the wall. And I just got engaged at the time, and stuff like that. I was a bit, oh shit, what's going to happen? But yeah, so it wasn't a surprise to me when it finally went. That was coming for a long time.
Yeah, so people could feel it. Like, obviously, not everyone understands. I mean, no one has insight completely into the balance sheet and sort of what the valuations of certain assets are going to be and stuff like that on your employer's balance sheet. But some people could feel
No,
like,
yeah, you just could feel things went right. I mean, say we were letting a lot of people go. The other thing as well that I remember calls with some hedge funds at the time, and some senior people at Lehman's that I was able to be a part of, and basically, Lehman just reassuring everyone that we don't have a solvency issue here at all. We feel well placed. And I kind of think they believe that, and is probably true. And again, it's kind of informed my sense that liquidity issues quickly become solvency issues.
Yeah.
And I think you've kind of seen that in Silicon Valley Bank and others. You know, the moment you have to start selling off your assets to raise the liquidity, and then you become a full seller, and then we have this spiral where collateral values that you think you've got on your as your assets quickly become worth a lot less, and then your liquidity problem goes to a solvency problem. But I remember I remember having calls with various hedge funds where we were trying to reassure of our solvency position, and there not being an issue. Their response back was, yeah, we don't have any issue, you guys, we get that. But at the same time, we were seeing them constantly unwind like all their swap business that they had on with Lehman's, and obviously their response was, look, we're just de-risking everywhere. But it was one of those where you get off the call and you're like, you're not de-risking. This is you've got deep concerns about things. So yeah, it was. I think people felt the writing was on the wall. I think maybe some of the longer term guys that had been there. I mean, Lehman built a real sense of family, and people had their life savings. Guys that are really good market guys. Having so much of their wealth in Lehman stock. I think they were probably more shocked, but maybe me coming in with fresher eyes really felt it. But yeah, it was for quite a few months, and really I think from the moment Bear Stearns went, it was it just felt the writing was on the wall. And one of the things it's really taught me is the whole thing of banking is a game of confidence, and everyone's trying to maintain the level of confidence in the system. So hence I don't feel better when I see Yellen come out and say the banking system's safe. When I see a bank CEO come out and say we've got no issue. Often if you're being forced to come out of those statements, you've got issues. And that's, I don't think the current situation in banks is 2008. I think it's very, very different. However, I'm aware of how complex and integrated our financial system is, and I can't believe when you've had two of the biggest bank failures in history in First Republic and Silicon Valley Bank, that the kind of butterfly effect of that isn't going to be felt still. And we kind of ran that in crypto right last year when you saw from the whole sort of Luna collapse and Celsius, and then you kind of felt that was all done, and then down the line we get FTX, which I think really was a result of that. I think you're going to see that in the banks, and how bad it is, I'm not sure, but one thing I do think is that we're going to see a really, really deep credit crunch that I think is going to drive quite a deep recession. So I am on the side that we will see Fed reverse those rate hikes pretty quickly, and certainly if they don't, then they're going to be forced into massive liquidity provision. I think the Fed balance sheet will explode as a result of what the Fed will need to do to kind of backstop the financial markets.
Which brings us to the same place, no matter what direction it goes. Yeah, it's the same end result.
Yeah, either way, which is maybe a dangerous, from a trading point of view, a dangerous position to be in, because I kind of feel it's like heads I win, tails you lose type situation. But the Fed, the reason what's driving this problem and the deposit outflows from banks is because rates are too high. And when you've got inverted yield curves, banks can't raise deposit rates sufficiently to stem the deposit outflow, which is in search of higher yields in money market funds. So therefore, they're gonna, if they raise deposit rates, they're going to become unprofitable, or they just keep them there, and then they're going to keep watching deposits flood out the system. So I don't see what stops that without the Fed cutting rates. Now the Fed have got this problem with inflation; it's still too high for them to come and address that. But what eventually will allow them to do it is I mean, you saw the slews, the lending numbers last night. Not as bad as feared, but it's not really taken into consideration events of the last couple of weeks. I think it would have caught the tail end of what had gone on with Silicon Valley Bank. So, but already within that, you're starting to see banks tighten credit. You're actually starting to see the end customers and demand for loans fall. So I think we're going to see quite a rapid deterioration in the US economy, and which will bring inflation down probably quite quickly, and then the Fed will have the cover to cut rates. If they don't, I just think the Fed balance sheet is going to explode, because I think the next bank that goes, JP Morgan can't buy everyone. And then they're going to have to backstop deposits and like the lending facilities they set up around Silicon Valley Bank and what have you, will start getting tapped in much bigger size.
Yeah, very interesting. Something that you said earlier, like liquidity events quickly become solvency events. I've heard this saying before, and I like it a lot. It's bankruptcy starts slowly, then it happens all at once. And I think a lot of things like that happen in society, whether it's, maybe a sovereign crisis happens slowly, then it happens all at once. A war happens slowly, then it happens all at once. And all those types of destabilizing events. And it just feels like that for whatever reason to me.
Yeah, and it's strange to me that, I mean, history, saying history doesn't repeat, but it often rhymes. And despite us knowing that, and it's funny, and sort of arguments I'll get in with people on Twitter, like that. I'm not saying the situation we're in now is 2008, but I think it's silly trying to draw 2008 comparisons, because every crisis is different, and we know that every crisis is different. So, it will be different. The spark and the trigger is always different. But nonetheless, when these things start slowly and then they happen all of a sudden, and it will be in areas that we're maybe not even thinking about. And subprime wasn't an issue back in 08. It's just a tiny sector of the market, and then we realised actually this is a really complex financial system, and actually a lot of the CLOs and all the derivatives that were sort of built on top of that, that they're the things that are in trouble. I think we're going to see the same thing, and I think people need to at least be open to the fact that the potential's there for that we're sitting on a big crisis. And again, that's not for the fear clickbait. I think that's just realistic, and history would tell you that potentially we're doing that, which is why I was surprised that the Fed, still hiked the other week. I thought, from a risk management point of view, it would have made sense to say, look, we're just going to hold off here, because another 25 bips probably doesn't do anything for inflation at this point. And in fact, we got the lags, and people forget that as well on inflation. You got a 12-month lag typically on monetary policy. So, we've barely started to feel the effects and the feed through from the tightening cycle of the last year. They are very much at the beginning of it this time of last year. So, for given how much they've done, and given you've got a banking sector that looks under immense stress, I think the prudent thing would have been to say, look, we're going to hold, see how this plays out. We think, the credit tightening is going to do the job. Inflation looks to have rolled over. But, potentially, whilst the 25 bits won't do much for inflation, it might be the thing that just, again, tips things over the edge.
Yeah, interesting. So, David, let's just wrap it up here. Thinking, what do you like to do outside of following macro, crypto, FX, global events? What do you like to do for fun?
Fun. So I've got two young daughters. They're 11 and 9. So they keep me busy. So a lot of my recreation's been replaced by taking them around so they can pursue theirs. But big sports fan, big football or soccer fan, as you guys would call it. So I played a lot of football when I was younger. So don't play so much now, but sort of follow that. And then I'm really big, like my kind of hobby, if you like, outside of the markets is I'm very much into like my meditation and sort of power of the mind type stuff. So like to meditate, and I'm just fascinated, with that the mind body sort of connection. Read a lot around that. I don't know if you know Wim Hof. Have you heard of Wim Hof?
No, I haven't.
Wim Hof breathing. So Wim Hof's a Dutch guy, and he's developed this breathing technique. that's sort of really cool. So sort of doing that, and he's got a whole sort of method involving ice baths and stuff. So yeah, quite into meditation. And then yeah, my sports huge, all sports. I've got quite into American sports over the last few years. Like the NFL has become quite big over here.
Cool.
So yeah, there's like Sunday nights now. I'm kind of glued to that.
That's
Enjoying
awesome.
that.
And then last question here: do you have any favorite trading books?
Joe, trading books? No. I'm not actually been a big reader of sort of trading books, but I like if I was to pick one out, it'd be Liar's Poker, I guess.
That's a great one.
But yeah, like yeah. So I kind of feel like my life's so much spent like in the game that when I'm reading a book, again, most of the books I read will be more around things with a more kind of spiritual feel. So like my favorite book would be like The Alchemist from Paulo Coelho. I don't know if you ever read that. But like that's probably sort of one of my favorite books, which kind of pushes the idea about, that sounding too off the wall, but like our connection to like universal energy and
Cool.
and like our the power we have to kind of create the lives that we want, and then the serendipity and coincidences in life, and I'm fascinated by that.
That is awesome. Well, David, thank you so much for coming on. Really appreciated your macro insights and your crypto insights all around. And I think listeners learned a lot, and I did as well. So thank you so much.
Thanks, Greg. Great to thanks for having me on.